Today, we're going to tackle a really fascinating puzzle in the world of accounting. How in the world do you put a price tag on an idea? We're diving deep into the world of billion-dollar assets that, believe it or not, are completely invisible.
So let me ask you a question. What do you think is a company's most valuable asset? Your mind probably jumps to their shiny headquarters, or maybe their huge factories, or all the products they have sitting in a warehouse. But what if it's none of that stuff?
Because, let's be honest, in today's economy, the real value, the big money, often comes from things you literally can't touch. We're talking about the power of a brand, that secret recipe, the customer loyalty they've built over decades. These are a company's intangible assets, and they are a massive headache for accountants, whose job it is to put a hard number on everything.
Okay, so let's get right into it and make sure we're all on the same page. What exactly is an intangible asset?
The official definition is actually pretty straightforward. It's a non-monetary asset that has no physical substance. Basically, if you can't drop it on your foot but it still makes the company money, you're probably looking at an intangible asset.
So let's look at some of the usual suspects. You've got patents that protect inventions, copyrights for things like books and music, those super powerful brand names and trademarks, super valuable customer lists, and then there's this really weird one we're going to get into later called goodwill.
Now here's where it gets interesting. Accountants basically split these into two buckets. On one side, you have identifiable intangibles. Think of a patent or a trademark. You could, in theory, sell that off by itself. But then you have unidentifiable intangibles, like a company's amazing reputation. You can't just sell that separately from the business itself. And this difference, it's absolutely crucial for what comes next.
Because that distinction leads us to what I think is the biggest plot twist in all of this. It's the one simple rule that solves the entire mystery of accounting for things you just can't see.
I mean, think about it for a second. We all know the Google brand is worth billions. The Coca-Cola brand is absolutely legendary. So it seems obvious, right? They should just be able to write that value down as an asset on their financial statements. Simple.
Well, you'd think so, but the answer is a hard, definite no. The accounting rulebook is crystal clear on this. It says companies are flat out forbidden from recognizing brands, customer lists, and things like that if they created them themselves. You just can't pull a value for your own brand out of thin air and slap it on the books.
So here it is. Here's the golden rule, the one thing you really need to remember. For an intangible asset to actually show up on a company's balance sheet, its value has to be proven through a real transaction. In other words, you have to have bought it from someone else.
Let's see what this looks like in the wild. This here is a snapshot from a real company's financial statement. See all those intangible assets they have listed? Things like patents and software. And hey, look at that giant number for goodwill. That value wasn't just made up. It was created because this company went out and bought other businesses.
So, okay, an intangible asset has made it onto the books. It was purchased, it's official. What happens then? Does it just hang out there forever?
Not exactly. After an intangible asset is officially on the balance sheet, it basically comes to a fork in the road. From here, it's headed for one of two different fates.
So path number one is for an asset with a limited life, like a patent that's going to expire in 20 years. The cost of that asset gets spread out or expensed over those 20 years. That process is called amortization. Path number two is for an asset with an indefinite life, like a super strong brand name. That doesn't get amortized. Instead, every single year, the company has to test it to see if it's lost any value, and that's called an impairment test.
Let's talk a little more about that first one, amortization. The easiest way to think about it is like depreciation, but for stuff you can't touch. That analogy of a hit song's popularity slowly fading, it's perfect. Amortization is just the accounting way of saying, hey, the economic benefit of this asset is being used up over time.
All right, now it's time to tackle the big one, the most common and, frankly, the most confusing intangible asset of them all, goodwill.
So what is goodwill? Well, at its core, it's just the premium you pay when you buy another company. It stands for all the valuable stuff you're getting that you can't really point to and price out individually. Their fantastic reputation, their amazing management team, or their super loyal customers. It's the value of all that good stuff combined.
And you might think calculating it is complicated, but it's actually just a simple subtraction problem. Let me just walk you through a quick example. You'll see how easy it is. All right, let's say Company A is buying Company B. They sit down, they negotiate, and they agree on a final purchase price of $260,000. Now, Company A does its homework. They add up the fair market value of everything in Company B that they can actually identify and measure. The buildings, the computers, the cash in the bank, minus any debts. And all that stuff comes to a total value of $120,000.
So, hang on. Company A paid $260,000 for a business whose identifiable assets are only worth $120,000. That difference, that extra $140,000 they paid, that is what gets recorded on Company A's books as goodwill. It's that simple.
So we've seen what these things are, how they get on the books, and what happens to them. But it brings up a big question. Why are the rules so incredibly strict about all this?
Well, it really all boils down to trust and objectivity. Think about it. If companies could just make up a value for their own brand, their financial statements would become pure fiction. You couldn't compare anyone. These rules exist to make sure that when you read a financial report, you can actually trust the numbers. It creates a level playing field and protects the integrity of the whole system.
And all this leaves us with a really fascinating final thought. If a company like Coca-Cola, which has one of the most valuable brands on the entire planet, can't list that brand as an asset because they built it themselves, it really makes you wonder, doesn't it? Does a company's balance sheet ever really tell you the full story of what it's truly worth? It's a great reminder that sometimes the most valuable things are the ones you'll never find on a spreadsheet.